Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter. I am going to talk about the real estate market and why it's so important. That cycle in the real estate market is what drives the money rotations in the system. And that's driven by demographics, driven by all that stuff. It's kind of going back to the thesis. We'll talk a little bit about the inversion of the yield curve and how this all fits with that cycle. The reason it's so important is because we haven't seen a commodity boom without credit expansion. So when we look at all these commodity booms in terms of uh, large across the board commodity increasing in pricing, that's always happened under a credit expansion phase. So it's the expansion of the real estate market. So bigger demographic like the 1970s, and I'll show you all this in some charts. This demographic came into home buying years, expanded that credit, and then we had a boom in credit. And that credit boom drove rotation of money differently because of the inflation and because of interest rates moving up and chasing that inflation. And what's important here and why I'm so adamant on where we are in the cycle is because that's the most important thing to understand. We are still underbuilt. Bar none, flat out, period. That is a fact. We are underbuilt by 6 to 7 million homes. The demographic coming into home buying years is a larger demographic than the baby boomers. I'm not sure if you were to wipe out the baby boomers, if that would be enough in terms of supply to overwhelm the millennials, because we are a larger cohort. There's a bigger population in the millennial group than there is in the baby boomers. Right now, we've got low inventories. So let's take a look at the data. You guys can make a decision for yourself on uh, what you think or where you fall with where we are in the cycle. So I'm going to go in. It's on Twitter. You can see this on Twitter. If you want to see what it is, it's at finding_finance. And if you want to join the community, it's finding-value.com. That's where I talk about individual stocks and how to play this next cycle in the commodity bull market. Now, this bull market is a little bit different. I think that we are hitting the constraints of what the world can give. But some people will say price will solve that. Okay, that's fine. But yeah, maybe I'm just in a little bit different camp on the supply side of it. So this is where I'm going to start. I'm going to go into this thread here. All right. And we're going to look at these charts and I'm going to kind of go through some similarities that I'll point out so everybody's on the same page and you guys can make the decision for yourself. So it says real estate. There's 4 phases of a real estate cycle. They are recovery, expansion, hypersupply, and recession. Real estate cycles are influenced by global crisis, population disparities. That's what I talk about a lot. Interest rates, but interest rates is really population disparity because it's just reacting to it. And overall economic health. And economic health is also tied to this cycle. So a crisis that's out of your control to some extent, population disparity, which is the larger demographic, and the larger demographic puts it into inflation, interest rates follow, and the overall economic health follows that population disparity. It creates jobs in this construction cycle. So if we were to look at this, this is the market quadrants. Those are the 4 phases: recovery, expansion, hypersupply, and recession. And what happens is, let me go to this next one here. I think this has it written out a little bit better here. This is new demand, not confirmed in the marketplace. There's mixed expectations when you go into a recovery phase. Then you get new demand confirmed, excess space absorbed. Basically, it's your inventory being drawn down to very low levels. Once you hit the average, this is the long-term average, You find out that space is difficult to find, rents rise rapidly toward new construction level. We are at this location somewhere in here where we're just above the average, and we're in space difficult to find, rents rising rapidly towards a new construction level. We are not in this phase up here yet. That is where demand growth continues, new construction begins, parallel expectations. So we're right kind of in between new construction kicking on to a very high level to work down those deficits in the underbuilt scenario. And then on the backside, when we have this gigantic crash or deleveraging the market, that's where your demand and supply basically equal each other. That's when your inventory levels increase to a level where you're at 6, 7, 8 months of supply going into a hypersupply phase. So that's where the supply growth is higher than demand and growth pushing vacancies up. We're not over here. We do not have vacancies going up. In fact, we've got very low inventories and things are still very high in terms of affordability. They're unaffordable. That puts us on this side of the map. Over here, affordability gets better, interest rates go down, and when the interest rates go down, since you're overbuilt, you don't have the push on pricing to go up. That demand supply is met. The demographic is smaller. So what happens is your housing market doesn't have that large push for the affordability to be poor. So the affordability gets better, interest rates go down, and the interest rates, the market isn't as sensitive to the interest rates going down because your demand has fallen off a cliff and supply has been met. So the market stays down for a while. It has to work through inventory, and basically you're in the bust phase at that cycle. And here at the bust phase, it's lower negative demand growth. Construction starts to slow, but completions push vacancies higher. And this is your hypersupply phase on the right-hand side. We, by definition, are not in a hypersupply phase because we don't have a hypersupply. It's so whoever says that we are going to crash or we're in a bubble, I don't know if they understand this cycle. Maybe they do, maybe they don't. I don't know. But we don't have the supply. And my question is, how is that supply going to come about? That is the question. And this cycle here, you get low inflation, low interest rates on this right-hand side or left-hand side over here. This is where inflation kicks up and interest rates kick up in this cycle. And then at the peak, you're going to have the interest rates will be paused. So they'll be increasing here, and then they'll pause them, and then they'll start to go down when everything starts to crash on the right-hand side because we built too many homes. That is the cycle. Low interest rate, low inflation, high interest rates, and that all starts to go back down. On this side over here, this is where your yield curve inverts. Your yield curve inverts on the expansion phase because the inflation is pushing the rates up. The long end of the curve stays relatively stable or more stable than the short end, and then the short end is going to move a lot. So when you're on this portion of the real estate cycle, what you're going to see is you're going to see the interest rates kick up, especially on the short end. And then the short end of that interest rate is going to invert. That is going to be in this cycle over here. And on this side, it starts to uninvert. Now, it can also happen in this section over here. We call it the mid-cycle wobble. And that can happen right after you go into an interest rate hiking. So the expansion phase will create inflation. You'll get very good growth in terms of prices in the real estate market. And then they're gonna hike the short end of the curve up. I think the mid-cycle wobble is going to be more, I'll say, it'll be a larger mid-cycle wobble than we had before because interest rates have been so low for so long. So when the interest rates go back up, it has to flush out a bunch of crap in the system that shouldn't exist in the markets because of the higher rates. So they could exist under lower rates, whether it be businesses, construction, or not construction, commercial real estate. There's things that need to be flushed out of the market because of the increasing of interest rates, and we get this kind of slowdown in the market. They call it the mid-cycle wobble. So when we look at this, and let me go to this thing here and go down. This is our active listing of inventory. We are still incredibly low, signaling that we are not in a hypersupply phase. We can't be by definition. So we're still at a very low inventory level. We're so low that it makes me think that we're in the middle of the cycle. So what happens is you draw down on your inventories to a very low level, which puts you in the middle of the cycle. The reason you're in the middle is because the inventory is low. You can't be towards the end of it because your inventory has to build back up, and you'd be off the charts above 2 million. 2, 3, 4 million is where you'd be if you were at a higher hypersupply phase. I would say average is about 2.5 million. We're at 563,000. We are at a very low inventory level. So we're smack dab in the middle of this inflation expansion phase in terms of inventory. And this is your housing starts. So this is your new privately owned housing unit starts, total units. Before a lot of these, they kick way up and they build a lot of homes above 2 million units. So we were above 2 million in the 1970s. We had inventories increase during this time frame, and we crashed, and that caused a recession. We did it again in the late 70s, crashed, had multiple recessions. We did that in the mid 2000s. In the mid 2000s, we were in a recovery phase here, and then we went above the average, and this was our mid-cycle wobble here. The mid-cycle wobble where you kind of come back down, and then we rip it, and we have a large increase in home prices and a large increase in housing starts all at the same time. Our inventories shot through the roof towards the back end of this cycle over here in 06, 07. Then we had a recession because all of the job losses in the construction cycle, a lot of people got laid off. The construction cycle ended, and we were in a hypersupply phase, and the demographic was not big enough to absorb those homes. Now we're the most underbuilt in the history of America ever. And we haven't built enough homes to satisfy that underbuilt condition. So we're still at a very average-ish level, and we haven't gone into that hypersupply phase, and we haven't gone into the expansion phase where we built the homes to increase the inventory level. So this is our underbuilt scenario. This is our single-family housing units completed. And you can see that we were above average in the 70s to late 70s. We went into a hyper supply phase in those red years in the mid 2000s. We overbuilt. We had a bunch of inventory, and I can show you that with our monthly inventory numbers. But over here, we've been underbuilding. This is our underbuilt 13 straight years below the 50-year average for the long-term average. That is what's causing this problem. We're underbuilt, and we've got a larger population demographic called the millennials coming into home buying years. It's the combination of those two things and the interaction between that demographic and the real estate market that's causing the inflation. We had inflation in the 70s. That's what these two big humps were. We also had an undersupply of commodities, especially oil. And that's where we get those investment opportunities. We had the same thing happen in the 2000s in this credit expansion phase. The reason you have these commodity booms is because the supply is low and the credit coming into the system flows into where the problems are in the market. So we have a large credit expansion, and that money puts everything into a shortage. And the money will flow to where the shortages are the greatest. And if you're under invested in commodities, they're going to flow to commodities, especially when your interest rates are going up. People are selling bonds because they're losing money in bonds from the interest rates being lower than inflation. So they put it in a real negative rate, they sell their bonds, and money starts to rotate. That is the cycle. We have not gone into, this goes to 2020, we have not gone into a hypersupply phase. We're barely at this line. This is your months of supply of houses in the United States. This is showing you where you're at in terms of inventory levels. Now, I know I don't have the most recent data here, but that data is at 2.5 months. We are right where my guy is down here. We're below everything. At the end of these cycles, you go into a hypersupply phase. This is the mid 1970s. We go to 10 months. Late 19 or early 1980s, we went to 10 months plus. We went over 10 months in the late 2000s because we overbuilt. That is what a hypersupply looks like. Hypersupply, hypersupply. There's another one here in the 90s, and hypersupply. What we're looking for is we're looking for commodities to be cheap in relationship to other assets at the same time that we're in an expansion phase of real estate where the credit in the system comes into the system and puts everything into a shortage. And then the money is going to rotate differently and go towards those shortages of commodities, especially when interest rates go up. But we cannot be in a hypersupply phase at 2.5 months down here. It is impossible. We didn't build the homes. And we can have a mid-cycle wobble, much like the 2000s did, where we go to a low level and we sit there for a little bit, go sideways until our inventory comes back from an overbuilt condition. But we haven't gone through that. We're at levels that are lower than any time in history in terms of inventory. So that's the problem. That's the disparity that I think people are missing, is that we are underbuilt and we have no inventory. Can the inventory go up? Yeah, it can go up, but it's not going to go to 10 months. You're going to have to build a bunch of homes to do that. I also talked about the housing market's underbuilt amid growing demand. We've got 6 to 7 million homes that were underbuilt in the market. These are the treasury yield spreads and business cycles over the last 50 years. These recessions were caused mainly by the housing market. The business cycle is the real estate cycle. And what you're going to see is right before a lot of these recessions or during the recessions, we go into a inverted yield curve. That's the red portion. The curve inverts because the short end of the curve goes up during those inflationary, expansionary periods. So every inverted curve here is right before a crash, because that's all that's telling us is that the curve is inverting because during that portion of the cycle, the curve inverts. And we went into a very large inversion of the curve during the 1970s because we've got large inflationary pressures from that population demographic. Now, keep in mind, we also cycled up and down, but so did the population demographic in terms of percent increase. So the demographic came in waves, which also, I think, caused those waves. I don't think the waves were natural to the market cycle, or maybe they partially are, because things need to be extinguished out of the system. Call it the mid-cycle wobble, where that interest rate goes up and things need to get flushed out of the system. But this inverted yield curve, it doesn't signal a recession. It's just signaling where you're at in the market cycle. So when you get into a late stage, you'll be inverted. That's all it's telling you. And then when it comes back on up, you're going to get a recession. So just because you're inverted doesn't mean you'll crash immediately. What I think you need is, I think you need inventory, and I think you need the housing market to really get you that crash, like a big crash. You can see here that we had an inversion here where the interest rates started to go up. And then we had a slowdown in the markets and the technology sector. I think this is what we're going to do is we're going to do this type of movement where we could come back up and slow down because there's a lot of things in the market that are that need to be flushed out of the system due to higher interest rates. But I don't think it's going to be caused by the housing market. So I think we're aligning for a potential slowdown recession, or we're in one based off of the interest rates going up and flushing this out. The problem is we are so underbuilt and we have so little inventory that the new inventory, that if people want to go buy a house, they're going to have to go buy a new house and they're going to have to build the home. That is where we're at in this cycle. And that is the cycle. You run out of existing inventory and you have to go build a bunch of new homes. But we could slow down due to affordability and we could slow down due to a recession. You know, keep in mind that during these large inverted curves here, we had unemployment go up and house prices go up at the same time. Unemployment is not a leading indicator of a housing market crash. Now, if you looked at the construction cycle and that were to dive rapidly and we had a lot of inventory, then I would say, yes, it is a problem because we're overbuilt and the credit will cease to keep coming into the system. But since we're underbuilt by 6 or 7 million homes and we have no existing inventory of real estate, we are probably, what's going to happen is we could go into a very large inverted yield curve at some point due to that. And that's exactly what all of these inverted curves are signaling. This is another person who's sharing some information. This is housing completions, also in expansion phase. Steady uptrend, new housing will probably peak around 2026. Hyper supply till the end of 27, followed by a recession. Completely agree. And we're just looking at this cycle here, and you can see that we're in this kind of upward channel, working our way higher, and eventually we'll get to a very high level. I think it's probably past 27, potentially, but we'll see. It all depends on how many homes are built, when they're built, and what the inventory levels look like, and how much immigration we have. And this is the housing starts. We're also in an expansion phase. You can see how this thing's going and moving on up. I think that we are very similar to the 2000s era, where we came on back, and then they lowered interest rates and shot this thing up. They also gave out a bunch of stupid loans. I think that's probably going to happen again, and we're going to go to a very high level, somewhere around 2 million plus, and we'll be up there for a little while. That's probably where we'll end up. So good chart there for Rick. Way to go. So that's the real estate market, and that's why it's such an important thing to understand, is because if we're at a different portion in that real estate market, we should be in completely different assets. In an expansionary phase, that's where your commodities take off. If you're in a hyper supply phase, you want to be in bonds. And if you crash and you're down low and everything's already crashed out, well, that's when you want to get loaded up in your technology stocks, technology in the S&P 500. But right now, we are still in that construction cycle. You're probably going to see large months of inventory of new homes, because that's what they have to do. They have to build a bunch of new homes, and you're going to have a bunch in, we'll call it WIP, work in progress, for new homes, and you're gonna have a large inventory of unfinished homes that they have to finish up, and that's where all the demand's going to be pushed towards new homes, and we have to expand the housing stock, so to speak. That's where we are in the cycle. If you disagree, put it in the comment section. Love to hear your guys' opinion on if you disagree or agree. I don't think a solid argument is that baby boomers are going to pass away and that all this inventory is just going to come out of nowhere. That hasn't been the case because we have low inventory. If that will be the case, we'll see it in the inventory numbers. And it usually takes a few years for inventory to climb in a market where we are so undersupplied. So there's going to have to be a mass die-off for that to happen, where you actually increase in inventory levels. So I don't think that's a valid argument for a quick housing bubble, saying that we're in a bubble right now. You could say that if inventory was up, 6+ months and increasing. I could definitely see that. But since the time frame and the lag of that inventory coming on, and we don't know exactly how that's going to interact with the demand out there, you can't make that conclusion. I don't think you're too early. That would be like saying that the race is going to end, but the race hasn't even started yet. It just doesn't make any sense. You can't make that argument at this time of where inventory levels are at. We can obviously state that the affordability is at one of the it's towards the unaffordable area at this time, but that you could also argue that that is where you've got the largest disparity between demand and supply. That puts you in the middle of the market, not towards the end of the market. You don't go through a low inventory era where affordability is good. You're the most unaffordable when the demand exceeds the supply the most. And that's where we're at. So we're actually in the middle of the cycle based off of that logic or reasoning. Other people use it and say that the affordability is what drives it, and it's not the case. I think that logic is flawed. Unaffordability is a function of where you are in the construction cycle, where you haven't been constructing new homes yet, and your existing inventory depletes to like basically nothing. And that's exactly where we're at. We're at an inventory level that is lower than any time in history. So how can that possibly be if you don't have that is a indication of an underbuilt market. Low inventory and unaffordability being at a very high unaffordable level. So all of that data is actually supportive of where we are in the market. It's not opposite. You don't go from what's going to happen is you're going to go to an unaffordable level, and it can slowly work its way down as homes are being built, and then eventually it'll work itself and crash when that cycle goes all the way to the opposite end of the spectrum. The bottom of the market is when it's the most affordable, because the bottom of the market, you get hit twice. You get hit twice on the way up, and then you get hit twice on the way down. House prices, when we go to an unaffordable area because the demographic is larger than what the housing stock is available, you're going to have interest rates be high and home prices be high at the same time. And that's going to reverse at some point. Maybe it's 10, 15 years away from now, where the bottom of the market's at. And that bottom of the market's going to have house prices go down and interest rates go down at the same time. And your affordability becomes better because of those two things. So that's where we are in the market. That's where I think we are in the cycle. And if we're in the middle of that cycle and we're in an expansionary phase, we are going to see a very large commodity boom over the next 3, 4, 5, 6, 7, 8, 9, 10 years, depending on how long this guy spits credit out of the system. So that's kind of the market, the thesis update. Now, the thesis, a lot of people talk, oh, your thesis is wrong. The thesis is right. This is right. You're arguing where we're at in the thesis. This is right no matter what. This has been proven by history. That's why you get those deleveraging events like the 1929. It saw all that. You're just arguing, people are arguing where we're at in the cycle. They're saying that we are at the high point and we've built too many homes in a hyper-supply phase. Problem is, where's the supply? You are wrong. We're not at a hyper-supply phase because our inventory of existing homes is 2.5 months, which is at the lowest level in history. That's like stating that a Bugatti is the cheapest car. Well, it's not. It's the most expensive car. You can't claim that. Maybe after it crashes, gets water flooding, and blows up, that maybe it's the cheapest car. But that hasn't happened yet. The crash hasn't happened. So that's my take on it. If you guys like the analysis, give me a thumb up. Subscribe to the channel. Subscribe to the website. This is what I'm using to know where we're at in the cycle. And I am staying long in commodities because of where we're at in this cycle. All right, guys, we'll catch you later. This is Finding Value.